Hello, and welcome to the Wade Borth podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. Hello, and welcome back to the Wade Borth podcast. Today, we're going to have a conversation around something that Nelson Nash mentioned in the book, Becoming Your Own Banker, which was the economic value added. Or EVA, which is the common terminology for it. And there's a lot of confusion around it, a lot of misconceptions around it. And so today what I thought I would do is just break down what this article was and what it was really saying. In Conversations with Nelson, if you sat through any of his live seminars, his book, he makes the comment, Fortune magazine article that was issued or published back in September 20th of 1993. I know it's been a long time ago, that's 30 plus years ago. But it's still relevant. But in there's this idea of economic value added. And again, it's a Fortune magazine article by Shawn Tully, I think Tully, September 20th, 1993. And you can go grab it, you can read it. But it really focuses on a couple of corporations, Coca-Cola, Quaker Oats, Railroads, CRX, and Briggs & Stratton. There's a number of companies, large companies that they looked at that focused on this idea of bringing value. So what does that mean and how does that relate to us? So we're going to get into that a little bit, but I just wanted to set the stage because I hear a lot of people talking about it and I don't know that everybody really understands it. And so I think the best thing we can do is start having conversations around it because really at the end of the day, what does this mean? What is economic value added? And the interesting part of the article is the tagline, the most important part of it is the very last sentence of the article. And I've said it before, and I just want everybody to hear it. If the EVA's basic premise is, if you understand what's really happening, you'll know what to do. Okay, let's talk about that a little bit. Why is this relevant to EVA? Because EVA doesn't look at profitability, it looks at the value that you bring to the use of capital. And capital can be a lot of different things. We've done a couple podcasts in the Wade Borth podcast. So if you want to go to Sagewell Strategy, grab those, go to Spotify. We've talked about what is capital. And capital can be money, it can be time, it can be people, it can be equipment, whatever it is. But are you getting a return? Are you finding value in those particular things? And where I think a lot of people get lost, and it states it a number of times in this article, is that people don't look at their capital and really understand if they're getting a return on that capital. And in particular, where it impacts us, especially in the IBC market world, is our capital being our cash. Are we getting a good enough return? Are we getting the proper return? Not a good enough, but are we getting the proper return on our capital when we put it to work? Now, places that do get the type of return they want are banks. And again, we can look at Chase, we can look at Wells Fargo. We understand that process is very simple. And again, this article goes into a lot deeper conversation because it's talking about inventory and equipment. If it's sitting idle, it's not being profitable. And it's not getting the return it needs. It's not getting the value. You're not getting the value out of it that you should be. Or the economic value out of it as you should be. Because, again, it was easy because we just looked at profitability versus the profitability of our capital. So I'm going to grab this article. I'm going to just pull out a couple of highlights in this article, and I just want to go through it in some of the lines and some of the things. And one of the key components here early on in the article goes, EVA makes managers act like shareholders. So think about that for a second. Put it in your own personal economy. Are you managing your money, or are you a shareholder of your assets, of your money? A lot of people say, hey, I need to manage my money, but managers look at things differently than shareholders and then stakeholders. Think about that for a second. If I own $100,000 of capital, of cash, and I know that's mine, do I treat it differently than somebody that's going to manage it for me? So just imagine somebody sitting down asking you that question. If you have capital, you have money. Let's just always refer to, in this scenario, let's always refer to capital as money. If I have capital or money, let's say it's $100,000, whatever the dollar amount is, it doesn't make any difference. Does somebody that's managing that money look at it differently than somebody that is the owner of, or the shareholder of that money? I know that if you're honest with yourself and we're honest with ourselves, we're going to say the people that own that money, me in particular, in my own personal economy, is going to treat it differently than a manager. Because I want there to be value generated from those dollars, not just to manage it to grow from $100,000 to $103,000. That's management of it. Rather than saying, I'm going to put that money to work and I want to see it generate cash flow. This is why you see a lot of real estate people understand this idea and this concept, because they don't see it as management to get to have an incremental return. They look at it as, how can I invest capital and get the value out of it that it deserves. So it's a bit of a different thought process, and it will take us a while. It's taken a lot of people a very long time to really get this, but just roll with me a little bit on this podcast. And again, if you want to listen to some other, we've talked about this idea of EVA, but maybe not this deep, go to the Wade Borth podcast or go to sagewealthstrategy.com and hop onto our BYOB conversations, or just our podcasts are there as well. But, and just understand that EVA is just a way of measuring an operation's real profitability. And if you think about it from your own personal economy, this is why IBC embraces this economic idea of EVA, how we measure our own real profitability of our dollars. If we take money and we put it to work, are we getting the return that we need? Because we have to understand what the cost is of putting that money to work. And then are we getting the return above and beyond what that cost is? And so here's another line that I thought was really interesting. He says, the total cost of the operations capital, the capital is all the money tied up in such things as heavy equipment, real estate, computers, and other stuff that expects to be productive for a while after it's been purchased, plus so-called working capital, mainly cash, inventories, and receivables. And that's the problem, is that we take a one-time purchase of something and then we say, okay, that's the cost, and then we just look at the interest as the cost going forward. Not so. We have to take a look at that upfront cost, that capital infusion, that money that we put into something, and say, what's our value of that thing going forward? Do we have a 10x, 20x, 50x times return on it, and not just an interest cost? So typical accounting will always look at it as, here's what the cost of interest is. But we don't look at what's the return on our capital. And it better be well in excess of, again, if I have $100,000, I'm just going to use that as I'm a simple farm boy from North Dakota, so I'm going to keep it simple. If we have $100,000 and we put it to work, and we know that there's a cost of 5% to have that money working, do we get 6% and we're happy because our business is running? No, we have to understand that we need to have 2 and 3 times that to say, I'm willing to put that capital to work, incur that expense, and now we want a return on it. And when we start thinking about in that standpoint, we start to think about where we deploy our capital in much different ways. And that's really the whole idea behind Nelson's Becoming Your Own Banker book, is that we have to treat money, we have to treat capital differently than we've been conditioned to think about it. Especially when the interest rates were low, even in today's interest rate environments, which are a little bit higher, people see their cash as something that doesn't have much value because it doesn't earn much, right? But we have to understand that the earnings isn't the 2 or 3% that we get in interest. The economic value added is that $100,000 can go out and buy 5 different properties or 4 different properties and all generate $500, $600, $700, $800 in cash flowing properties, right? The whole point is that when we put it to work, we just have to understand that we need that return above and beyond, and it's a multiple of what the cost of the interest is. When we look at economic value added, it's just, again, going back to saying, what is the value we're getting from that capital infusion? And that has to be an ongoing calculation. It can't just be a one-time thing, or it can't be just an interest cost. Because what else could we be doing with those dollars had we not invested in that property, or we not invested in that business? And that's the real key. Where's the other opportunities that we haven't been able to take the opportunity of because we've put it to work somewhere else? And we start thinking in that sense, we're going to be a lot more selective where we put our dollars and then what we're charging for that. So part of the conversation I was having with a gentleman one time, he was talking about how profitable his real estate investments were. And then we got looking at, he had capital infusions. And I said, hey, that's great. I'm glad that your property is turning such a great profit. I said, but you've missed some cost items. And the biggest cost item I could see there was the cost of his capital. And he said, it was my cash. And so I had him read this article. And once he read this article, he goes, oh, I grossly over calculated what my profitability on his real estate was. And when he started adding in what the cost of his capital was and the use of his capital into those calculations, he became a lot more discerning about what kind of properties he should buy. Because think about this. If you could take your money and Let me just say, you can go buy something and you don't count all the expenses, all deals are going to look great. Anything that's going to have more than what you originally put into it, all deals will look great if you don't count for all the expenses. The expense that most people get and most people don't recognize is the cost of their capital. Yeah, so just one of the other lines that says the cost of borrowed capital shows up in the company's interest expenses, but the cost of equity capital, which the shareholders have contributed, typically appears nowhere in any financial statements. This is directly out of the article that we're quoting. So let me read that to you again. So I'm going to start a little bit sooner. It says much capital or what it costs. Most have no idea how much capital they tie up or what it costs. So think about this from our personal perspective. We don't know how much capital we've tied up in a lot of different stuff or what it costs. The cost of borrowing capital shows up in the company's interest expense. So the cost of that, but the cost of the equity capital, which the shareholders or you have contributed, typically appears nowhere in any financial statement. Again, what's that cost? It's a lost opportunity cost. And the equity is an extraordinarily expensive capital. So we have to make sure that we're getting the return out of it that we have to have. And the interesting thing that this article makes, and again, this is somebody that's writing for Fortune magazine, it's not me. He says EVA has been lost, the even darker muddiness of accounting. And so accounting, because it makes it's fairly muddy, this idea of what that capital truly costs is lost in the accounting. They account for what the interest is, but nothing else beyond that. So one of the examples they were talking about, it was CSX, which was, I believe they're still operational, but bear with me if they're not. They're part of their railroad group. And they basically said that they had a negative $70 million because they had equipment sitting and doing nothing. And so the CEO of that time gave them an ultimatum. He said, get your EVA up to a break-even point in the next couple of years or we're going to all be sold. And so the interesting part was what they did is they started looking at, they had inventory sitting on the sidelines. They had rail cars not being used. They had trains that were being used but not at a full capacity basis. So when they started taking a look at what the real cost was of the capital, again, they took money to buy all this equipment. That money it's a one-time charge. And so they look at it as, there's 3% interest or 5% interest, whatever it might be, to do it. They just didn't see it as being real expensive. But if they said, what's the cost of that capital sitting there? The whole cost, not just the interest on that cost. They go, we need to make this a lot more profitable. And so that mindset, just a shift in that mindset, turned their business around from losing $70 million to earning 25% profitability in a couple of years. So in essence, they end up earning $70 million on those assets versus losing $70 million. So the point I would make is that they reduced the amount of empty boxcars. They made sure that when cars were moving, they were full. They were just a lot more cognizant of that very expensive asset, which was their capital. And so this is where I want to bring it back to the individual. When we put our money to work, our capital work, we have to be super cognizant of how we treat it. And so everybody that's listened to my podcast before heard me say this, is that you have to love yourself and your family more than you love Wells Fargo. And that is so true because they understand what the cost of capital is and they charge accordingly. And they get a return on their capital, not just a return of interest. We see it as I pay 3, I'm going to charge 5. And it is a 2%, or pay 6, I should say. That is a 3% interest. When in all reality, that's a 100% markup. So you have to have a better understanding of what that really is for your capital. Because your capital is a business in of itself. Especially when we're talking with an IBC world, that business of banking, the process of banking, the thought, the mentality of banking says, if I put capital to work, I put money to work, I need to have a return. And if I'm the shareholder of that business, not just the manager of that business, I want to make sure I get a good enough return. Even if I'm borrowing to myself or to my family, I need to have a return because I'm a shareholder of that business. And I think that's the part that's lost sometimes, not always, but I think there's some real lessons to be learned. Again, it goes back to cash flow. The statement that the one with the greatest cash flow always wins. I don't know if that's a Robert Kiyosaki saying, I've heard it said many times, but that's ultimately what we want to do. And when we take money and generate cash flow from that capital, the greatest cash flow is always going to win. The idea of EVA. And again, there's a lot of different examples in this article. I would encourage you to go read the article. It's really interesting because it will take us some time to get our minds around that. Again, I've heard it said that infinite banking is caught, it's not taught. This is part of catching it. Once you start reading this article and these type of articles, you have an understanding that how we look at things has to change. And then the way we look at things will ultimately change, right? And the way we look at it is our money is super valuable. Our cash is super valuable. So when we put it to work, we have to make sure it gets the value that is due it when we put it on the street and we put it to work. If we do it with our own business, our own selves, our family, complete strangers, whatever it might be, we have to make sure that we get a return on our capital, not just an interest rate. And understand that when we put the capital to work, what are those other opportunities that we could be using it for if we didn't put it to work in this particular spot? And I would just encourage you to read the article. We can go through a lot of different things, but there's another little point in this article which I think is so relevant to how we think as individuals about our money. There was a Quaker. Now, Quaker is the oatmeal company that most people know, right? There's a plant manager that said, I used to treat inventories or capital like they were free. Think about how most people think about their money, right? They see as their cash, as their inventories, they treated it like they were free. And so when you start realizing that is not free, then you start thinking a little bit differently. And how we charge for it and how we have to respect it will start to change as well. So again, remember, you're in a business. You're in two businesses. You're in the one that you're generating income with. You're also in the banking business. And that idea of how we think about money and how we use it and how we put it to work and how we charge for it is all part of that business. Now, you can make a choice. You can either give that to somebody else, Wells Fargo, Chase, whoever it might be, or you can take part of that and say, I'm going to control parts of that. I'm going to control part of that banking function in my lives. But that comes with the responsibility of understanding that when I put it to work, and the discipline of saying, when I put it to work, I have to pay it back. If I put it to work with myself, my business, my family, or a complete stranger, I have to make sure we have rules in place and we make that happen. And I think that's the biggest part about EVA. You can control that cost of your capital, and then you charge accordingly. Your profitability of that business, that particular business, which is called the banking business. Now, we're not starting a true bank. Get that. It's just that thought process, the verb of banking. And once we understand and control the cost and or charge accordingly for those costs, our earnings in that business and that verb of banking will flourish. And I think that's probably the biggest thing. So remember, economic value, EVA, basic principle says if you understand what's really going on, what's happening, you'll know what to do. Part of this podcast, part of my purpose in life is to help you understand what's going on. Give you enough information to understand what's going on, and then you'll truly know what to do. So if you want to have a deeper discussion, if you want to talk about this, Wade at Sagewell Strategy, and let's book an appointment, let's have that conversation. Hop onto our website, sagewellstrategy.com, book an appointment there, have a conversation with me, listen to the rest of my podcast, and we can have this conversation because this is truly understanding what's going on. And people are going to point to say, well, this is an old concept, this is over 30 years old. This isn't an old concept, this has been around forever. It was just identified back in 93 from this article. It's not like he created this idea. This has always been there. It's like that natural awareness. Just like Nelson always talked about this idea of infinite banking. It's not something he created, but he brought a lot of awareness to this idea that we need to control the banking function in our lives, and it has to be done at the you and me level. This article just supports that idea as well. I know it was one of his favorites, and he loved this conversation because people have to have a little bit of mind shift. We have to have some imagination that, hey, what we've been taught to believe maybe isn't always true. So now we can go back and say, oh, let's start thinking about how we put our capital at work, and then when we do, what's the true cost of that? All right, I appreciate your time listening to this. I encourage you to go out and find the article, Fortune Magazine, article by Shawn Tully, September 20th, 1993, and just EVA or economic value added. So do a search, you'll find the easy article, and hopefully we'll have a conversation about this soon. Thank you. If you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button and please leave a review. This will help this podcast reach and help more people by ranking higher in searches and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family, as we can be easily found on Apple Podcasts and Spotify.